Good morning and welcome to today's AOD UTP lesson. This is your host and presenter Jesus Reyes, and we are coming to you live from sunny Miami. Today is Wednesday, March 22nd, 2017, and it is now 11:01 a.m. If you could kindly confirm that everything is working okay and you can hear my voice and see MTI Online University on homepage on your screen. Thank you for the heads up on that, Kent. I do appreciate the information. Good morning to you and welcome to the room. Good morning, Bay, and welcome to the room. I see some are still joining. As you do so, if you could kindly confirm that everything is working okay. A simple Y or yes should be enough or will suffice to that end. Thank you very much, Luri. Thank you very much, VA. Excellent. I do appreciate the confirmation. Allows me to confirm that everything is working okay, and if any adjustments need to be made. Now, today we are going to be talking about timeframes, which is something that I believe, following on some of your comments, sometimes we have some traders have issue when they are going through the through their technical analysis, and they are moving from one time frame to the next. As they start to move from the monthly to the weekly to the daily to the 2-hour, sometimes you get a bit confused in the relation or the apparent direction of the market from one time frame to the other. So we are going to be addressing that today, as well as topics such as well as points such as if I like to trade the 15-minute, what should I be paying attention to? If I like to trade on the 1-hour, what could I be paying attention to? If it's the 2-hour where I like to place my trades, where should I be looking for the setups? So we will be talking about that as well. Now, please take the opportunity to go to where it says my courses, or if you're already logged in, you can also just click directly here on Ultimate Traders package and then scroll down the list to the Wealth and Freedom Experience live event title. Click on and download the manual, and then under the table of contents we'll find time frames under page 88. So 88 and 5 would be 93. There you go. So I'll give you guys a moment. Type in a Y or a yes or done ready when you're on this page. It would be page 93 of the PDF file or 88 of the document if you have it printed out already. I'll give you guys a moment to get to it. Please let me know once you're there. Here I see something in the meantime. A chart in question: when I switch time frames in the UCS, the trend lines disappear in many cases. If you see a trend line disappearing, make sure, if sometimes this will happen when you link the trend line from a higher time frame to a lower time frame, because, and that can happen because the point of origin of that trend line is too far into as far into the past in regards to the lower one. So that the lower time frame, not that having that point as a reference from where to draw it, will erase it. So that could be the case. If that's not the case, if it's that you're drawing a trend line on that specific time frame, on that same time frame, and that initial point is still active, it's still present on that chart, and still the trend line disappears, then what I'd suggest is that you contact tech support, because as far as I understand it, that should not be happening. Okay? So based on what I'm understanding from your question, it should only happen in the example that I addressed initially. In any other condition, it shouldn't be happening. It should not happen. Now, we're all set, so let's carry on. Now, let me move this away. As you all know, or should know by now, the larger time frames control the price movement on the smaller time frames. Smaller time frames will respond. Let me find this. Smaller time frames will respond to the A, B, C, Ds of the larger time frames, which means that at this point, when we go to a smaller time frame, we should anticipate, or we should be able to identify U-turns. In this case, because the market stops forming lower lows and lower highs and starts to form higher highs and higher lows as it goes from the B to the C. And once the B to C price movement has been completed, then we should stop seeing higher highs and higher lows and the market reversing to start forming lower lows and lower highs. So at these points, we should be able to identify reversal patterns such as head and shoulders, or king's crowns. At all of these points, A's, B's, and this the same, the opposite direction, of course, going bullish. C's and D's. So expect U-turns or trend reversals on the smaller time frames when C's and D's are hit. Remember that once the market completes the A, B, C, D movement, the C becomes the new A, and the D becomes the new B. and a new swing forms. So here you'll see another U-turn as the market goes from the new B to look for the new C. And then as the C is found, you'll see another U-turn back down as the market continues to go from C to D. And as long as the trend holds, you should see those ABCDs continue to form. Wow. Okay, very terrible news that. Seems to have an incident seems to have occurred in the British Parliament. Terrible news, yes. Here I'm reading that UK Prime Minister is safe following incident at UK Parliament. Okay. Hopefully no one was seriously injured. Now, as you may understand, the large ABCDs, or the ABCDs on the larger time frames, will be comprised by smaller ABCDs from the lower time frame. So this B to C movement, you'll find smaller sub-ABCDs that will likely be the capital swings from the weekly, which at the same time will be comprised by even smaller weekly subswings that will likely be the capital swings from the daily and so on. So if I go to the daily time frame, you will likely see that this up AB from the daily will be made out of several sub ABCD swings from the 2-hour. And as the market U-turns and starts to go back down, looking, in this case, going from a super shallow pullback up to the 127, now maybe looking for the 382 down here, that will be achieved by a series of down ABCDs on the 2-hour. So we're likely will have seen a U-turn here, and when and if the market finds a retracement within the up AB, we should see a new U-turn as the market starts to go back up again. So these smaller waves that you see here, this segment was kind of an aggressive move. But if we focus on this, market going down, A to B, C to D, A to B, C to D, and we're currently following that move. So the ABCDs on the larger time frame will be comprised by several smaller waves or swings from the lower time frame. So you can see here on the daily, the market is going up. We have this up AB between 101.18 and 113.88. This is 101.18. and this is 113.88 around here, and that whole swing is comprised by 3 up ABCD swings from the 2 hour. And now we are should be in down ABCDs as the market U-turned at the 127, and it's now making its way down to the daily 382, which we've already identified at 109.03. And there you go. So that would be my daily swing brought down to the 2 hour. And here you see the movement to fulfill that retracement to the 382 taking place on the 2 hour time frame. Now, we have a time frame where we look for setups, and we have a time frame where we look for the entries. Now, due to the fact that the larger time frames controls the price movement on the smaller time frame, there are key time frame relations or relationships that you could look to follow. So if you like trading on the 5-minute chart, you should be looking to monitor the 1 hour. Setups on the 1 hour, entries on the 5-minute. Setups on the 2 hours, and you take your entries on the 15-minute. You look for setups on the 4 hour, and you look to enter on the 1 hour. Setups on the daily to the 2 hour, setups on the weekly, and entries on the daily, and setups on the monthly, and you take them on the weekly. You will find traders that, though this structure of time frames relations may use alternatively the 2 hour or the 1 hour identifying setups on the daily. Okay, but this is the key relation between larger to lower time frames. Now, based on the education, we are taught to trade the C to D. By trading the C to D part of the swing, we are trading in the direction of the overall trend. Because remember that we identify the trend, the direction, we plot our fibs in that direction, and by trading the C to D, we are following that overall move. Now the distance from C to D will vary based on the time frame in which you trade. So if you trade on the 15-minute, the average amounts of pips that you'll find as the market goes from C to D will be approximately 45. Well, right now we're not talking about indicators, we're talking mainly about the time frames. I know that the stochastic, which is the indicator that you're bringing our attention to, is one that allows you to anticipate whether the market has likely exhausted a move that is getting ready to U-turn. But that being an indicator, try to use that to complement what the market is doing. So if you have the market at a high price and you see the stochastic in the sell zone, then excellent. It is adding to the fact that the market is at a high price. So it is a very good indicator, it is a reliable indicator, but I give more weight to what the market is doing. You are very welcome. Now, if you trade on the 1 hour, a C to D move will in average offer 180 pips of trading opportunity. To the if you go on a 2 hour, it becomes 240. If you trade off the daily, then it's about 600 pips from C to D, and so on as you move to larger time frames. Now, this is an average distance that will exist from C to D. You need to factor in another element, which is the DTR. Now, not all pairs have the same DTR. You will find and DTR stands for daily trading range, which is the amount of pips that a currency moves in a given day. Now, you'll find pairs that move anywhere between 50 and 60 pips a day, and you'll find pairs that move 2,000 or 3,000 pips a day. Okay? So if you bring that into the equation, you will also anticipate that the C to D movement can become shorter or larger depending on the DTR. So the larger the DTR, the larger the distance from C to D. And by using all of these elements, you can anticipate that it will take more or less time for pairs to cover that to fulfill those C to D movements. Now, we basically divide traders. You'll find two types of traders. One, long-term or position trader or swing traders, and short-term or scalping. Which one to follow will basically depend on your personal preferences, on how you feel more comfortable approaching trades, on the amount of time that you can allocate on a daily basis to take positions and manage the positions that you take. So MTI traders look to trade on smaller time frames the direction from C to D of the larger time frames. So let's say we monitor the daily, we trade on the 2 hour. As the market on the daily goes from C to D, I go to the 1 hour looking to trade in that direction. Now, how do I look to take my trades? Am I going to be scalping the move on the 2 hour of the C to D movement on the daily, or am I going to look for ABCDs and sub-ABCDs or trade those swings? Position traders, swing traders, prefer long-term positions, which are trades that to be fulfilled will take more than 1 day. Now, if I go to a daily chart, Remember that on the daily chart, let's say that this is the swing that I'm going after. I'm going to take this away for a moment. And this was the swing. So once I have identified, I'm looking to sell the C to D part of the swing. And if the market pulled back to a 786, I can anticipate the target to be found at the 127, which means that I'm going to be looking to trade this move on the 2-hour time frame. So on a 2-hour, I'm going to look to identify and trade all the down ABCDs. So I go to the 2-hour and I identify those swings. Let me see if I can do something here. I'm going to bring this, link it to the lower time frame, or better yet, I can do this. Yes. I'm going to erase everything here for a moment. I don't have enough data, so let me add some more candlesticks. Okay, I made it. Did I? Yes, I did. So, let me see if I can bring that swing as well. So if I bring that daily swing, yes, to a lower time frame, this is my daily A. This is my daily B. And what I'm looking to trade is monitoring the daily for setups, trading the push zone on the 2-hour, trading the daily push zone on the 2-hour. So daily A, daily B, the market breaks the inner trend line, allowing me at this point, so if I'm here, of course hindsight is 20/20, but I see the market rallying, pushing back up, I'm looking for a break, and here I have an inner CTL break. I could start to anticipate that the market might start, it could be going in the opposite direction. Okay, I can wait and see, okay, the market took out a low. So on the 2-hour, I'm going to start trading the push zone of the daily swing. So what do I start doing? I start looking for swings. Now, if I use my daily encapsulation tool, and I'm going to continue trading my swings as the market continues to move down. Now let's say that here the market took me out, took the A out. If I already know that I'm at what could potentially be the daily push zone, as the market gives me a new opportunity, I'm going to start looking for down ABCDs again. So I sold here, took some profit, swing traded the second swing, took profit, third swing takes me out. I bring my attention back to the daily. I acknowledge the A has not been taken out yet. The capital A high has not been taken out. So the next opportunity that the market gives me, I start plotting my down ABCDs again and continue looking for entry opportunities. And again, down ABCDs. Now, what I mentioned about what best adjusts to your trading style and the time that you have to take trades and manage them is whether you are going to be selling from C to D, or if you're going to be selling CTL breaks along the way. Are you going to be scalping the market, or are you going to be selling the swings all the way down to the crown D, to the daily D extension? Okay, the thing that, regardless of how you look to trade, is that you need to understand the overall direction and whether the larger time frame, depending on which is the time frame in which you look to trade, if the larger time frame is already in the push zone, so you can move to the corresponding lower time frame and start looking for entry opportunities. Here the market rallied again. I start plotting down ABCDs again. Or I look for the next CTL. I sold this one right here. I got stopped out evidently, and then I start to see the market pull back up and back up again, so I look for my next break. It breaks here and I start selling again, or I wait for the next swing and I start selling again. And I repeat that process here. I got stopped out, so I wait again for a high price. Remember that once you have direction, all you need to look are for the entries, and you know that you're looking for selling opportunities. And here the market finally hit the D extension from the daily. So if you go to the daily encapsulation tool, you'll see that that took approximately 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. 1, 2, 3, 4, 5, 6, 7, 8, 9, 30. 1, 2, 3, 4, 5, 6, 7, 8, 9, 40. 1, 2, 3, 4, 5, 6, 7, 8, 9, 50. 1, 2, 3, 4, 5, 6, 7, 8, 9, 59 days approximately to fulfill the swing. So those were 59 days starting approximately on November 17th, 2015, all the way from November to February of the following year, where you should have been focusing on looking for high prices from where to sell. If at one point the market stopped you out, then you wait for the next high price to form and you continue looking for those lower highs that the market will form as it goes to fulfill that push zone, and you continue looking to sell. So basically here you had 2 months worth of selling opportunities. Are they pullbacks? Yes. Could the correction be deep? In this case, you see that the market broke the trend line. It broke, came back and tested, bounced, pulled back, broke, came back and tested, and completed the swing. So there will be times where you'll likely be staying out. For example, from here to here. Why? Because it's trading in the opposite direction of the trend. You know that you should be looking to sell. These are the areas that you're looking for. Every time the market starts to move down, that's when you should be looking to sell. You will have pullbacks. You will have corrections. Now you have the opportunity in those cases of trading that corrective movement. That is always an option. But if you trade that correction, are you trading in the direction of the trend, or are you trading against the trend? What would you be doing if you trade? In this case, you would be, if you're buying the red squares, the movement within the red rectangles. Hmm? Will these trades be high probability trades? Buying here and buying here? Or would it be best to wait for the market to give you opportunities to trend in the direction of the larger time frame? Yes, you wait. You wait. So you here had an you had here an opportunity, overall opportunity of approximately 290 pips and about the same going up. But that's not your interest. Your interest is trading in the direction of the trend as it moves from C to D, which then you waited 300 pips for the market to go up, and then you had approximately 600 going down. Then the market pulled back up about 500, and then it pushed down to the D 700. So which is offering you more trading opportunity when it comes to a pip count? The market moving in the direction of the trend, or the market moving in the opposite direction with the trend? Really? Exactly. Yes. I mixed for a moment. Was about to speak in Spanish. All right. So that's the point. Trade in the direction of the trend. And of course, you will see here on the 2-hour, as the market corrects, given those pullbacks, it takes out the capital A's. Go back to the daily. Remember that reversals are to be found, as we read at the beginning of the session today, where the A, B, C's, and D's are. Here is where the actual reversals takes place. The market stopped moving from B to C, and it is now looking the C to D. Here you have a U-turn. Here you buy. Here you should expect the market to go up. Here you should anticipate a reversal. Now let's see if we identify one. Let me take this away now. Now look here at this A. We have a king's crown. Left tip to low, center tip to a lower low, right tip, and the market dipped. Near this B, I'm not seeing much actually in this case. It was an aggressive dip, and then the market fell into sideways movement until it broke out. So it's not a clear indication of how the market reversed there at that on the B of that swing. But now we move to where the C took place. And here you find yourself with a left tip, center tip. Where could the market have taken? Well, this could be a right tip and a dip, or something that we'll find many cases with the dollar, with the yen, as a left shoulder, Here we have a nice alignment, and the market dropped. Corrected, pulled back, and then continued to dip. And if I go to where the D is, well, similar to the previous B, not quite clear, but you get the overall picture. So, why not do both? Well, what do you mean by both? The trend is your friend until it bends, indeed. Both direction, you mean buying and selling? Buying the corrections and selling the movements to the D? There are enough pips in both directions, no doubt, but the risk is not the same. The risk will not be the same. Because if you are buying the correction, you're buying the short-term move, not the long-term move. So you should be expecting the market to U-turn. You should be expecting the market to drop, not to rally. That rallies are corrections that could have ended here, or could have ended here, or could have just continued to dip. So by trading in the opposite direction, you are assuming more risks because you're going up against the movement on the larger time frame. And MTI traders are looking to trade on the smaller time frame, following the direction from the C to D from the larger time push zone, which is why I used the daily swing and I brought it to the 2-hour to elaborate on that principle. Now, how would you decide to do that? I mean, can you do it? Yes. Would you be following the principles of the education? No. Could you make profit? Yes. Could you lose? Yes. Why? Because you are taking higher risk by doing so. So how do you decide to trade that? Again, long-term, position trading, long-term trading, sell the C's on the way down as the market waves. A to B, sell the C, sell A to B, sell the C's, and so on. Or, and wait until the D is hit, then get out, wait for the pullback and sell again. Hit the D, get out, wait for the pullback and sell again. Or, and this could take more than one day, more than likely, 3 days, 1 week. Again, we already established that this whole move took about 2 months, 3 months to fulfill. So each swing will easily be at the very least 2 or 3 days. Or you go and you sell, you scalp the market. Every time you get a CTL break, you sell the market. And you continue to do so until the market hits the D from the larger time frame. Does this make sense? Does this shed some light on how one should address using the larger to trade it on the lower time frame? How to learn how to acknowledge that maybe that A that is being taken out will not necessarily be a reversal unless it is on those specific points from the larger time frame. So it may be a crown, yes. You may find a crown because the capital A of the lower time frame was indeed taken out, but it might be a deep correction. It might just be a deep correction before the market continues to dip. So proper reversals will be found on the A, B, C, and D points. So choose the time frame that you want to monitor, follow and identify the setups there, and then identify the push zone. And once you are in that push zone, bring your attention to the lower time frame that relates to it and start looking for entry opportunities. Swing trading, scalping, using any of the strategies available to you based on the UTP. Excellent. Yes, and always use proper risk-reward ratios, no doubt about that. Having said that, I want to thank you all for joining. I want to thank you all for your participation. I appreciate you taking from your time to join me and allowing me to share this information with you, which I hope will contribute to your Forex education. Much success on the rest of your trading day. If you want to join me via Analyst on Demand, we'll be starting there in about 10 minutes. On that note, this is Jesus Reyes signing out for now. Until next time, my friends.